Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for about the next 25 minutes here on Options Guy TV. All right, so Mr. Powell is still up on the hill, and I say still because this interview, meeting, presentation, questioning began yesterday, and based off of what Jay Powell has said, talked a little bit about the outlook from the Fed, the meeting that's going to be coming up in July. Then we're also going out to September, but the market has taken it as a positive, hinting that there is a potential for a rate cut. And because of that, all the markets are up today. Not to mention the fact that they're all flirting with all-time highs, except for the small caps, which is the Russell 2000 index and some of those other indexes. That's the only area that is lagging a little bit is five, and it's not even really lagging. It's just that it's not doing as well as the Nasdaq or the S&P 500 index. So on Monday, we talked about the fact that we're coming into earnings season. And I always like to think of earnings season beginning with JP Morgan's announcement, which is on the financial side of things. We do actually have Delta Airlines is going to be announcing on Thursday, and that's a fairly big one. But I'm going to focus on the financials in a little bit because of this potential rate cut. I do think they've legged the market. They've done well. Charles Schwab, JP Morgan, even the XLF, the ETF that tracks a lot of the financials, but that one's not really fair because it has Berkshire Hathaway in it. That's actually their biggest holding inside the XLF, and also some Visa and some MasterCard, but they're all considered financials. And the companies, so far, the XLF has had a decent run, I should say, but I think the time is right to try to get long some financial stocks. Today, I'm going to just play with a trade in JPM, but I don't mind getting, if you were going to be buying stock in JP Morgan, I don't think I would mind buying stock prior to the earnings report. Last quarter, they actually had kind of a tough quarter, and I'm going to pull up. Here's some information I actually get from a good friend through a Substack that he creates and puts out, and it's awesome. His name is Russell Rhodes. He's a professor, and just puts this out from his own goodwill, just asking for donations. But one of the things that he likes to look at is what's the long straddle around important companies, or I should say, well-followed companies like JP Morgan. And then also we have Citigroup and we have Wells Fargo that are going to all be announcing on Friday. And last quarter, JP Morgan, with an expected move of around 3%, a little bit more than 3%, which is where it's at actually this Friday coming up. And the market was actually down 6.5%. And then he goes so far as to look at the last 12 quarters and where the expected move was for the underlying stock. This is basically what the options marketplace is telling you the move should be, using the nearest expiration to that earnings report. And over the last 12 quarters, it's averaged about a 3% expected move prior to the earnings. And last quarter, they were down 6.5%. The tide's turning in the financials. Things are looking a little bit, the sun will come out tomorrow-ish in the financials. So I'm going to say, well, JP Morgan is still one of the leaders in the space. And the fact that they got beat up last time around on their earnings and did double what the expected move was is just interesting in general. So let's first just start out by looking at JP Morgan's chart. So let's run to the TradeHawk software. And there we have it. And look at, we've had a strong move up. Well, that's Tesla. That's the trade that we're going to look at today. Here's JP Morgan. Let's add some days here, and then we're going to zoom in so that we got a decent moving average. But we have our ducks in a row. We have the 200-day, and above that is the 50-day, and above that is the 20-day. So we've had some chop since the since the beginning of the year, since February, it looks like. And now the market wants to break out. This it, this is the big down day from the last earnings report that we had. Market kind of chopped around. We've taken all of that back. And now we're in this little flux where the market just wants to know where to go next. And I'm hoping that, in my mind, that this earnings report could be a catalyst. And yeah, let's just leave it there. So I don't mind the chart. I don't mind what's going on in the marketplace in general. Uh, Recently, even if you look at the XLF stocks, which I actually have a watch list on them, if you see today, now these are the main ones. Visa and MasterCard are in here, JP Morgan, Berkshire, Bank of America, Charles Schwab, let me think, Ally Financial. All those stocks are doing all right. They're not at the all-time highs, most of them, but they have had solid movement. I think in light of the rate cuts, the marketplace has taken that as a positive. So enough about that. I think we're going to set up the trade. I was going to look at the Tesla trade, but let's set up the JP Morgan trade. Okay. So it's going to be short and sweet. And I'm just going to basically put on a speculative trade that is going to be a 50-50 bet in JP Morgan. The expected move, and we just slowed down quite a bit, is $6.22. So that divided by where JP Morgan is at is about a 3% move, which is what Russell actually posted in his Substack that he sends out. Okay, there we go. I'm moving again, but I'm still struggling. Oh, there we go. Great. And here's the very first expiration, which is July 2nd. Now, I would probably put this, they're going to announce before the earnings before the market on Friday. They're going to announce their earnings before the market on Friday. I would normally put this on Thursday, closer to the close today, but we don't have a show on Thursday, so I'm just going to do this today. And I'm going to straddle where the market is at. And this is perfect because we're at 207.55. So we got to strike right at that level. So easy enough to come in. And all we want to do is do a long call spread. We're going to buy the 205 and sell. Oh, I did that backwards. And sell the 210. So here we go. Buy on the call side of things. And we're going to sell here. And so if we're going 5 points wide, the trade should be trading somewhere close to the midpoint of the spread. So 5 point wide spread, halfway point is 250. This should trade for somewhere close to 250. You're going to be buying the same amount of time premium as you are selling. So if we look at it, we're actually a little bit less than that. Market's up just a tad. So we're at 243. So that's our midpoint. This is going to be a trade. We are going to bet 250 to make 250. That's basically the concept. We're going to straddle the market. Only a 3% move, which you can obviously, we're talking here, a 2.5 point move, half of that move. If the earnings are good, all right, we should open above the 210. If they're not good, they should open below 205. It is possible that it could be somewhere within that range, but highly unlikely that it would be somewhere within that range. Like what's going on in the financials, JP Morgan had a bad quarter last quarter. I'm hoping that they will bounce back, and I'm willing to do a 50-50 bet on that earnings report on Friday. One day for these option contracts to live, and that is it. And that's the way that we're going to look at it. Now, that will be that paper trade. Very interesting trade that we did on Monday, and it's all about the setup. So I'm excited to show you this trade. On one of my videos, I actually did a Tesla time spread because they're going to be the first of the Meg 7 to announce earnings, and they're going to announce. I had it written down. I want to say the 18th. It was 26th would be that week because you see the difference in implied volatility, and it's going to be Tuesday of that week. So let me look at when the 26th is at. So it's going to be the 23rd that they're going to be announcing earnings. And as far as the Meg 7 is concerned, this is the first company to announce earnings in the Meg 7. Okay. I looked at a long call side of things in a different video that I put out, and I had a target price of 260. So that one obviously worked out on the call side of things. You'd already be out of the trade. On the put side, I also went the opposite direction on Monday's show and did a long calendar using the 240 strike put. Because if you do look at the chart on Tesla, it's not going to help you out much, honestly. And that the move is parabolic, right? We came all the way up, and one thing that there, let me pull this in. That is interesting is we came all the way up fairly close to this new high. Like right here's the high is 265.72. So we bumped right up against that. And now the market's down right around 261.80, which was actually perfect for that strike calendar. But there's really nothing here to look at in that the moves are just leaping on the way up. So vol is high. Implied volatility had when we set up our long calendar spreads, we want to buy the expiration that we think implied volatility could go up in, the one after the earnings, and sell the expiration that will expire prior to the earnings and we think implied volatility can go down. So dead wrong on the way we thought the market would go, or I did by looking at this trade. The market is still extremely volatile. It's obviously had gone up quickly in the short term, which adds some nervousness to the downside of the market going into this earning. The July 19th expiration is 9 days away. The 26th is 16 days away. We used the July 19th for the option contract that we sold, and we sold it here for, right now, I think we sold it for about $350 or so, and now it's trading at $2.29 in the bid. And then we hit the ask here and we bought this one, and 536 is where this is trading at. Okay. Market has moved about 10 points to the upside since we put on that trade. If I jump back to the chart, you can see that we were right around here on the chart, and now we're right up here, 261.72. Going back to this trade, and if I pull up my screenshot from the day that we did this trade, this is crazy to me, honestly, is that we put this trade on. The market was at, well, here, let me just pull it up because I just want to show you that this is the actual screenshot. Okay, there it goes. And let's move out a little bit. Here we go. Let me get this set up. Okay, and boom. All right, so we'll keep this in the background. Here you are. Just so you know that I'm not fibbing you. Here's the 240 strike. We sold that strike, and then we went to the next week, which is this one, the July 26th, and we bought that for $512. The market was at 256.29, so I thought it was closer to 250, but it was 256.29. That's right. When I took the screenshot, the market was up quite a bit on that day. I remember paying somewhere around 5. I think that's where it was. We'll say 512. But the market has gone down, and look at where this trade is at. There we go. Here it is. 536. We're actually up 30 cents, and we were dead wrong on the trade. Why? Because we set it up right. Here's the big difference is vol on this 26 strike option when we put the trade on was at 74. It is now, let's call it 80, very close to 80. That's 6 points. So in order to explain what happened here, I wanted to pull up Vega. Now, Vega, it says on the options grid here is 18. That's based off of 100 shares. So it's really 0.18 or 18 cents for every 1 point movement in implied volatility. So if you take 18 Well, first of all, let's start by getting the number of vol points that has moved. Now, this isn't an exact science, but I just want to give you a feel for why this happened. Dead wrong on the direction, but still doing decent on the trade. Um, you take 80 minus 74. On the screenshot, you could actually see that it was at 74, and you look at the tape later if you want to. I'm not going to try to pull it back up again. And 18 times 6, that's about $1. So in that instance, we've actually gone up. Yes, I think let me make sure that it was 6 points. So I had $1 before. Yeah, 74. That's where that ball was, 74. And now we see it at 80. Vega, if we assume that the Vega was still where it was at around 18 cents times 6 points, that's 108, $1.08. So just on implied volatility alone, the option contract that we own went up approximately $1 because of implied volatility. We lost money on the way down, but also on the 19 strike, this implied volatility came down and we had a nice large rate of time decay. That all said and done, we're actually up on this trade. We're actually this trade right now is trading for $5.40. If we flip the script and we bought this one and sold that one, we could get out for $5.40. And I might do that mainly because we kind of got a gift. We were dead wrong on the outlook. And now we could get out at a net profit to the account. So not a bad way to trade. It was all about the way that we set it up. We wanted the implied volatility on the option contract that we bought to go up. We wanted the implied volatility on the option contract that we sold to go down. Both of that happened. This was just as much a volatility play as it was a directional play. Now, on the call side of things, that 260 strike call, which I've been watching too because I have that position on also, is that's up about $3. So we're up 30 cents on the put side of things, and we're up $3 on the call side of things. And we did the 240 strike here, and on the call side, I did the 260 strike. It was both done on the same day. Very interesting trade, very interesting dynamic for option pricing. I'm actually glad the market went down because this is what happens when you set up a trade correctly and you get vol on your side. Now, this position could still lose if the market did continue to go up in Tesla. This position could hurt quite a bit. Now, you can also take on the thought that I'm just going to buy this back. I've made about $1 on that trade. I can buy this back, and I can just get long the put option going into this expiration and hope for the worst, if you will, on Tesla. Or I could buy it back, capture that dollar, and actually sell something a little bit higher. And that's not a bad alternative. Now that the market has moved up, I can take $1 of profit out of this one and maybe sell the three. Yeah, I don't want to get too nuts on this. We'll go and sell something that we started with. We sold an option contract that was right around $3.30. Let's do that. So take $1 profit off the table, lowering our cost basis overall. Not a bad way to approach it. I probably would just sell it and close out the trade, but let me show you this adjustment. You are going to have a requirement if you do this, but you're still taking advantage of the time decay and the fact that this could imply volatility could continue on up, and this one might continue on down, and you have expiration approaching. So here's the way that you would look at this trade. Okay, we are short this one. Let's just get rid of it. Okay. So instead of selling, we are buying. We're buying to close. It's going to say open down here because it won't allow me to say close because I don't have the position in this account. And we're buying to open that one, and that'll be a buy to close. And then we would sell to open the 245s. And there you go. You got your buck. But you're adding 5 points of risk because now you have the obligation to buy the stock at 245, and you are still long the July contract, which says that you have the obligation to put the stock to somebody at 240. So that's 5 points wide. So that is just like a short vertical spread. So you're going to have to put up $5, but you're going to gain $1 in net credit, and you're still hoping that this option contract expires worthless. And that's the way that's a very valid adjustment based off of the fact that we were dead wrong on our forecast and we still got some option contracts and we still have some profit. So let's take a little bit of the profit off the table on the July 19th, help out our July 26th long option contract. There you have it. All right. Any questions on that? I don't know how you couldn't have questions on that. That was all over the place because it just doesn't make sense. And I have stared at the screens, making sure that I did not put a buy where a sell should be, because when you look at something like this that seems too good to be true, it usually is. But the trade worked out. That's exactly where we are at. All right, that's it for this edition of Options Guy TV. My name is Brian Overby, author of the Options Playbook. You can watch this on X, looking at my handle on X, which is very simple. It's at my name, at Brian Overby. And you can watch us inside the Tradier Hub. You can ask questions if you build a sign-on inside the Tradier Hub. And then also if you log in to YouTube, you can ask questions via the Tradier YouTube channel. Thanks for stopping. We'll see you this Friday after the all-important JP Morgan report Friday morning, and we'll see where we're at. Thanks for coming, everyone.
Thanks for watching. Please be sure to take some time to read the disclaimer. Thank you.